sort of try to approach this topic is to start thinking about, what are the various problem statements that we see that people within the industry are facing, and the challenges and obstacles they are facing, and then from that perspective, we would look at it from the angle of whether from the industry, from the vendors, and us would help as consultants also helping banks or maybe other financial institutions to deal with this issue. So maybe I'll just pass over to Satyam to talk about from the industry perspective. Yeah.
Thanks, Gary, and hello everyone. My name is Satyam Agrawal. I'm with a platform, SME platform called Global Linker. So just quickly a 30 seconds introduction to Global Linker. We are out and out an SME platform with the vision to build a global community of digitized SMEs. And we do that by partnering with banks, financial institutions, telcos, and so on, who kind of bring in their SMEs to a platform, and we create a singular digital community of SMEs, helping them digitize and so on. But just my personal background, have spent like close to 20 years working with large international banks, running SME portfolios across multiple countries. And Gary, to your question on the challenges, I've actually seen this whole space change, and maybe if I can just go back to the early part of let's say 2010 and so on, where the entire regulatory landscape around financial crime risk or customer due diligence changed. So I think the clear view regulators started having was the financial net system needs to kind of protect against any risks of let's say anti-money laundering, sanctions, and so on. And for banks, it was a big wake-up call, because banks still then kind of thought that if we put the fence around our house, that's good enough for us. Whereas the regulator had a very different views in most countries that that's just not good enough. You need to also act as a policeman. So one kind of making sure that the financial network or the financial system is not used for by bad actors for wrong activities. Equally, if you see anything that's suspicious, anything that's unusual, it's the responsibility of a lot of financial institutions to kind of report it. And there's a massive shift in this whole expectations from financial institutions, from the regulators. And to sum it up in possibly one sentence, I would say, today most banks can actually lend, let's say $30,000, $40,000, $50,000 to a lot of corporates or to SMEs businesses without meeting them, but you cannot accept deposits without meeting them, and that's how the whole regulatory landscape has kind of switched. Now, if you just start seeing it from a bank's perspective, particularly some of the large financial institutions, it was a massive shift, and they were absolutely, I would say, in some lot of ways unprepared to deal with it. Like a lot of banks knew how to manage credit risk and all that, and because any customer from a credit risk standpoint, if he goes bad, that's like a direct impact, on their profit and loss, and hence, they knew how to manage that risk. They knew, what happens if a customer goes bad, how to deal with it. But when it came to dealing with financial crime risk, it was something very new. And as a result of that, what started happening was at the top end for large corporates, I mean, banks did put a lot of resources, invested in a lot of resources to kind of address the whole issue around the new standards around, let's say, customer onboarding and so corporate onboarding and so on. And equally, they did for the lower end, for consumers. But the segment that possibly got most impacted was SMEs. And unfortunately, a lot of banks took the convenient choice, of even exiting a lot of those customers because they just found it's too expensive to kind of manage and all that. Now, if I just look at from a consumer perspective, from large corporates, they were more than willing to kind of provide the required information, even if it meant lot more information, data that was required by organizations. Even at the lower end, I would say consumers, 99% of them didn't get impacted that much. Whereas again, SME, which is a segment I kind of managed a lot, did get massively involved. And a lot of SMEs were like very good standing customers of organizations for a long time, and suddenly they realized that either they're being asked for significantly higher level of information, or even instances, their accounts being put on, let's say, freeze or hold and so on, without kind of exactly knowing the reasons, or they're being told to kind of find another organization or institution, to bank with. So that's kind of the challenge the industry, I would say, kind of went through, where the pendulum kind of swung from one end, where banks completely, I mean, this was not at all on the radar, starting, early part of, I would say, the last decade, to going to the other extreme, where for a lot of organizations that kind of, they just went to the other extreme, where customer experience and if customer centricity took a backseat, and it came at the cost of a lot of customers get impacted, and part of the reason was the whole regulatory landscape was changing so rapidly, and when you have to fix a moving car while it's moving, it was always challenging, and banks didn't have the systems. Even the ability, people, talent, and all that was kind of built over the last 4 to 5 years.
Thank you for that. Maybe Pascal, from the perspective.
Thank you. Yeah, I mean, first of all, a quick intro. So my name is Pascal Nizri. I've been in the financial industry for 20 years, working as a managing director for HSBC in many global and country roles. And I co-founded Chekk, which is a digital identity leader. In a nutshell, we provide secure end-to-end solutions to enable financial institutions to perform KYC for individuals in 30 seconds, KYB for corporates in a few minutes, with all the features like leading edge stuff like automatic company unwrapping and UBO discovery globally for 350 million businesses, smart AML capabilities with native language input and output, advanced ID&V, like in a few seconds we do the full Monty of identity and verifications, and also a lot of data portability and privacy capabilities that really make a game-changing experience. And that's what's enabled to have a perpetual KYC and KYB across 200 countries. So if I go back to the problem statement, Gary, you were mentioning, and building on what Satyam just said, on the back of all that, those new regulations coming out over the last few decades, and the banks and the financial institutions at large being kind of suddenly faced with a lot of things they need to ask their customers and verify and all, it kind of led to new systems, new processes, new forms being deployed, being put in place in the banks. And we have all experienced it. We are all customers of banks for retail or corporate relationships we have with them. And as you can see, it created over the last decade a lot of impact, as Satyam said, on customer experience, on the time it takes to onboard, like the turnaround time, the time it takes to onboard. If you're an individual customer, it's already feeling so long. But if you are a business, it is not uncommon in many banks that it takes weeks, if not months, to be onboarded. And then, of course, when you look at the forms and the questions that are being asked, it's like dozens, hundreds of questions and data and documents that are being requested. So obviously, on the back of that, after a while, most of the financial institutions, once they felt that they were more comfortable meeting the regulatory requirements, started to have appetite to streamline that, to optimize it, to make it a better process and better experience for their customers. And most of them aspire actually to have an instant onboarding, immediate product fulfillment, and all of that, even for corporates. And there's plenty of good people and good ideas in financial institutions. And I'm not saying that because most of us around the call here were in some of them. But what you can see, there's been many internal projects going on to try and address what I've just mentioned. But unfortunately, not always successful. And just look at the experience you've had yourself the last time you opened a bank account, and look at what your friends or contact on the WhatsApp groups and all that you have are telling you. It's still, unfortunately, often a bit clunky, a bit long. And there's plenty of reasons for that, because of legacy systems, because of how sometimes financial institutions interpret some of those regulations. But the result is still a lot of paper, still very long time, still a bad customer experience and all. So sometimes to address that problem, FIs then, financial institutions then want to work with fintech or regtech startups to solve this. But unfortunately, there again, they are sometimes limited by many things, which make things much harder for them to leverage the modern platform like fintech and regtech solutions. And it might be coming from governance, from architecture, from data management. I mean, I've seen recently, for instance, a bank which wasn't able to add a simple API call to their system for 4 months. And it was because IT and business teams couldn't even work well together. So there's a lot of reasons sometimes, but there are ways though. There are ways that they can address that. So it's not, I'm not trying to try to kind of stipulate the postulate of, oh, it's all hopeless. There are definitely ways where for financial institutions to make something out of that, either by modernizing their platform to then be able to plug more modern APIs to it and enhance their own systems, and or use some out-of-the-box SaaS solutions, which can then work in tandem with some of the older legacy systems. And that's actually why at Chekk, we decided to have both APIs and out-of-the-box SaaS frontends, because we wanted to be able to cater for this pragmatic situation. So that's kind of what we've seen from the inside and the outside of the banking world. Gary, back to you.
Yeah, thanks, Pascal. So maybe a quick introduction about me, and then a bit of my views as well. I'm a regulatory partner at KPMG in Singapore. I head the regulatory practice leader in regulatory and compliance, as well as the financial risk management practice. I started this journey actually, Satyam was talking about, in the earlier years when we talked about, a lot of remediation work was focused on AML, right? Basically on making sure that the files, sources of wealth, sources of funds, things start to age, and they used to use the good old school way. Right now, the people are looking at it in a very different aspect, right? So a lot of money has been spent. We can see all the fines that happened as well. So everyone's trying to leverage technology. I think, and also this is exacerbated by COVID. I think when you have an experience with, people like Lazada or Shopee, and the experience is so seamless, right? I mean, everything, and it's a very unfair comparison, but people are demanding, whether it's corporates or even the consumers are actually expecting that kind of seamless customer experience. But banks try to deal with it from a multi-channel approach, right? So you have the credit working with the bank on different credits, etc. Then you have the onboarding, then you have the RM, and they're all different multi-channels. They try to come together, but unfortunately, that's the problem. So banks are starting to think about omni-channels, right? From the point of view of a customer, seamless experience. But they are laden with a lot of old legacy systems. And I think the way people are going now is really what we call microservices, basically stitching together a solution that helps to accelerate some of these experiences in some parts of the business and trying to come to an understanding of a customer journey. And that's why, KPMG, we work with Chekk, and that's the ability for them to be able to have these microservices, talking about smartphone technology, onboarding, having, some of these data challenges, or trying to deal with these issues. So I think for me, that's the basic where I'm seeing a lot of clients, the likes of all these digital banks. They're looking at it from a consumer perspective. Front end looks all very nice. They're all aspiring to do that. But at the back end, a lot of manual work, because I think, you still see a lot of lack of maturity from that space. And if you're talking about machine learning and all that, it requires a certain amount of time for the data to be learned. So even though there's data to be bought out there, you still need to personalize it for your own type of business and your own clientele. And that takes time. So I think although as seamless as it wants to be, there are certain challenges as well with the approach. That's from me. I don't know whether the other panel members want to chip in, or shall we move to the next topic, maybe?
It's okay.
Yeah. Okay. So I think we now talked about the problem statements and what we are seeing with our respective clients in this particular corporate environment and all that. Let's turn to the regulatory environment, right? Because that also starts to think about although regulators are trying to have a level playing field, implement all these people at the periphery who actually do a lot of financial intermediation but are not subject to AML rules. What are we seeing from that perspective, right? How do we make corporate onboarding a bit more, what are the challenges that we have, from a regulatory perspective, in terms of information gathering? So maybe I'll pass it to Pascal to kind of share from that perspective. Yeah.
Yep. Yeah. Thank you, Gary. I guess one of the key things when it comes to corporate onboarding that we see is making a big difference, and that a lot of regulators or government are trying to focus on, are the corporate registries. So actually, there are in some countries registries where a lot of the information about the businesses are available to the banks to then onboard those businesses in a much easier way. However, it's not necessarily a one-size-fits-all when it comes to the reliability, the exhaustiveness, and all of those kind of registries around the world. And there are many of them, ACRA in Singapore, Infograph in France, there's so many that exist. They have various, but they are not all equal when it comes to some very exhaustive, some pretty poor. And even when some of those registries are at the forefront of corporate registries, and we, for instance, have in mind Singapore, it's still sometimes not enough to have a full picture of the entire shareholding structure of a large corporate, for instance. And that's something that you can see for yourself when you go and look at the data in there. So that's why it's, in my belief, I think it's important for financial institutions that want to have a streamlined corporate onboarding to have a multi-source strategy. And that's a bit like what we're doing and how we view the world, because it's important to leverage the corporate registries that bring a lot of fresh information, the official golden source of data, supposedly the freshest that should exist. It depends, obviously, it can be older or in some countries, but usually quite fresh, and combine that with the commercial data providers of this world, which sometimes gather data that aren't in registries and that you cannot necessarily find otherwise by just connecting to an ACRA of this world. And that's how you get, I believe, a good combination of freshness, depth, and coverage. And that's why, for instance, we connect directly to some of those live registries, but we also have a partnership agreement with Bureau van Dijk and data providers like this to help us do that multi-source approach. A key part of what I see when it comes to corporate onboarding. And another that we've seen regulators and government focus on a lot in the last few years are what we call KYC utilities. And it's something, of course, that we know well, and there's clearly a need. And the principle of the KYC utility is to avoid the duplicative efforts and the duplicative request of data, because time and time again, when a corporate is multi-banked, they would tend to give the data so many times and with a lot of issues on data and synchronization of data and all of that. So that's why sometimes regulators are looking to put in place KYC utilities where the data can be shared and reused across various financial institutions and beyond. And so there's been plenty of those projects. And actually, we've been involved in some of those, and Gary could talk more about it. And full disclosure, there is actually a strategic alliance between KPMG and Chekk, and we do many activities together in Singapore, Hong Kong, and France. And some of those have been around the KYC utilities. So that's why I'm a bit more educated on the matter. But Gary, you would be even better than me to talk about this.
Thank you, Pascal. So yeah, this is something that I'm quite passionate about, actually, because as a national agenda, we have been shortlisted by the Association of Banks to really think about an operating model for KYC utility. We've tried many times as a country to be able to put this across, but of course it has its own challenges. I think the whole idea of the advantage of having a utility is basically to try to reduce the duplication of onboarding and have a single repository of someone's information across different banks, right? So right now, when you have opened a bank, a corporate opens a bank in different institutions, you don't have a single view. MES will keep on calling, okay, is this your customer? Is that your customer? Etc. The only likeness of that maybe is the credit bureau, but other than that, I faded out for a while. Am I back? Yes.
Yeah,
yes,
you're
you
back.
are.
We just lost you for 10 seconds.
Yes. Sorry about that. So I think that is the aspiration of the regulators. The further futuristic view is also talking about interoperability between different types of FIs, because we deal with the banks first, then talking about capital market players, asset managers, and the likes of many others in the periphery, and also even across jurisdictions. because someone can have open an account in Hong Kong and pretend that it's coming, not sharing the same type of information across different jurisdictions. So they will look for arbitrage opportunities of sorts. So I think that's a good aspiration that we want to have, but I think there are challenges. I think the main challenge, of course, legislation currently in itself doesn't allow banks to share information so freely. This thing goes against what we have in Singapore, and it makes it a good financial institution of a certain international standards, banking secrecy and client confidentiality. So to be able to operate a utility where you're merging all the information together poses some of this interesting, exposure for other institutions or whoever manages it to be able to then have access to this information. And potentially, we've talked about this. It could be a honeypot, or someone takes control of this information. Of course, we have many other mechanisms, technological mechanisms to deal with these risks, whether it's centralized, decentralized, but we will not get into the technical stuff about this. But safe to say, that's one of the challenges that banks will have. First of all, banks will need to agree on a consistent standard. They will agree as a minimum hygiene. And as you know, banks are very competitive in nature. To come together to sit at a table to agree on some consistent standard so they can apply to a go ahead with utility is a challenge in itself. So you need a standard setting person. The other thing is banks have also heavily invested, because most of the banks here in Singapore are by and large global entities, and they go for global service agreements with the huge vendors and all that. So having to then burden them with an additional layer of technology stack sometimes has also this element of decommissioning or duplication of sorts. Some of the things that we invested in terms of AML investments on, or whether it's onboarding or whether it's transaction monitoring. The other thing is also a challenge is that it's not a partnership of equals. So let's say you have a few banks, some of them inherently, like the likes of local banks, they may have more customers than other foreign banks who have been exposed to very small market. They may have a smaller pot of retail customers or corporate customers, but the likes of maybe are just like DBS and all that. They've been here for yonks, right? And they have more corporate customers. So how do you compare that with a bank that may have not have as many customers, and it'll be seen as an advantage to the guys that have less customers to be able to draw from the banks that have more customers. So it's really something that you need to try to equalize that balance, right? And we've done some approaches in terms of the economic model, right? So if there's a refresh and it's your customer, maybe perhaps you pay less and all that, but it still creates a lot of inertia and resistance, right? Because as I'm standing here, I got more customers. Why do I even need to get into this partnership when I have the most advantage? Of course, one of the mechanisms of a utility is over time, there needs to be some kind of what we call seeding or mutualization of sorts, because you need to have a single view of a customer. In itself, as a process, as part of the utility, is a very expensive endeavor, right? To come to the cycle of that, we see how you have a single view. In order to have a single view, you must mutualize data to have a single view, and that role of mutualization sometimes is quite costly, etc. And I think the standards and all that have been to be adhered to, and that also is one of the challenges, because each bank sees risk, they manage risk. They are not in the business of avoiding risk, so they manage risk and they see risk differently, and that's where I think also one of the challenges that we see. So yeah, I think I better stop there before I carry on and make it all very negative. But that's a big passion about why the utilities sometimes take a challenge. So I think where the regulators are coming on now is not, hey, let's not try to look at this from a cost or operational efficiency perspective. We don't want the utility to end up facilitating the bad guys in the systems already, right? Because you keep on revising them and they're already in the system, you're just reinstating them. How do you stop the bad guys from even opening a bank account? That is the real challenge that we are seeing from where the government is coming from. Yeah, I'll stop there. Maybe I'll pass that now to Satyam to have a share about maybe from an SME perspective, how this regulatory environment, I think he just mentioned that in the opening, but I think maybe you could reiterate some of the points or give us some fresh views as well. Satyam?
Absolutely. Thanks, Gary. And just before I talk about SMEs, the way I kind of see this. And in my mind, if I just play back 30, 40, 50 years back when credit bureaus didn't exist, I'm sure a lot of similar challenges or questions were debated as to bringing credit bureau. There would be a benefit to a specific, let's say, a bank to begin with. Maybe other banks will be at loss. But my sense is, I think what we'll have to think about is the larger community at large, and how does it benefit? How do you keep the bad actors from using the system or the network, right? Financial institution for bad activities, right? If you start with that goal, then just like credit bureau, it starts working on a reciprocal arrangement. And eventually, I would believe every single organization that participates would kind of, benefit from it. Although initially, maybe in the next near future, it might sound like, somebody's losing more versus somebody's gaining more. But that is where I would imagine it would end. And just one example, I think to the earlier point on single source of truth, right? So I saw this fantastic example in China, where every time we open a new bank account for a corporate or any business, if their records don't match with the records which is with the utility or a central database, the financial institution is not allowed to open the account, and the customer or the business has to go and update that first, and only then the bank is open. So that's like it does create a bit of a experience issue at times, but at large it just makes sure that the utility or the central repository always has the most updated data. And over a period of time, businesses understand that if they need accounts to be opened swiftly, or if they want new financial services to be provided or be available to them swiftly, there's a need for them to go and they need to be disciplined about updating their profile or records in the central repository. Now coming to SME, I mean that's a segment I'm very passionate about, and I firmly believe that with everything that happened, the segment that got most impacted was SMEs, because as I said, unlike large corporates where at a unit level they were like very profitable, and banks had the time and energy and everything to kind of invest and fix that issue as the regulatory landscape changed. SMEs didn't enjoy the same privilege, because at a unit level they are small. And unfortunately, as I said, in my opening, that a lot of banks made the convenient decision that given all the challenges we face, I mean, this is possibly it's going to be the last segment that we're going to address, and hence either kind of let's not bring in any more SMEs, or even maybe stop serving the SMEs that we currently have on our portfolio, which was not the best, because I mean, if you look at any economy across the world, I would imagine the following statements would absolutely be true. More than 95 or even 99% of businesses would qualify, would be SMEs, contributing to anywhere between 40 to 60% of GDP, contributing anywhere between 60 to 80% of employment. Now that's the importance of SMEs collectively. But because at a unit level they are small, it just creates that challenge to serve them, efficiently at a low cost, and that is where if you do a cost to serve or a cost benefit analysis, that just becomes the most ethical, and that's where a lot of organizations took that choice. So seen that kind of happening, and that is where the whole landscape, as the regulatory landscape has changed. But equally, what's changed is the whole digital landscape, right? And as you mentioned, Gary, the expectations of customers, but also new forms of data that's being available. And how can, I would say, banks or financial institutions use that intelligently, to onboard SME customers? Because if one uses the lens to onboard the SME customers, the same lens as, let's say, a large corporate, that's definitely not going to work. And I say that for multiple reasons. One, the structure of these SMEs, the entity structure is a lot simpler. So they don't have like multiple layers. They're not owned by another company. Most instances, they would be owned by one business owner or maybe two, or in some instances they might have a parent company, but that's about it. Won't be like a complex structure, which kind of runs into multiple layers and owned by multiple shareholders. Secondly, again, their nature of business and their requirements often tend to be a lot simpler. The products that they need from financial institutions often tend to be, a lot simpler and not complex. And most of the products that they ask for or they want are very standard products, which way you can possibly put a cookie cutter approach, saying that SME would require maybe a business account, maybe a a solution where he can pay his employees, something where he can collect money from his buyers and pay his suppliers. So it tends to be a lot simpler than what a large corporate would require. But the challenge, I guess, that's been in the industry so far has been that maybe in a lot of instances the same lens as large corporates has been used to look at SMEs, and obviously the trade-offs are not going to match. When you do that, when you're looking at something with lower revenues, lower complexity compared to large corporates.
Thank you for that excellent perspective from an SME's perspective. Maybe we should now move on to talk about what, so in response to all these challenges that we see from the regulators and all that. Now it's time to go from the perspective of what actually banks are doing. Before maybe I would talk about sharing about what I see in banks. Banks are starting to think about the resourcing models, right? Whether they should do this from a managed service, they're looking for outside help, in a more cookie cutter way of doing it rather, and etc. And also, I think of late we've seen banks start to think about technology, and this whole area and interest of data and big data, and they're looking at I think the main bulk of it, maybe not from the onboarding stage, but also talking about false positives, sanctions, alerts, dispensing with alerts. A lot of effort has been put there because as they calibrate the way they get their alerts, and then they have to deal with all these false alerts. So there's a lot of these things market technology players out there is trying to triangulate data and say all these are similar alerts, put them in the same group, and then you can dispense off with that. Because the regulators are starting to look very closely at that as well, because some banks use that as a means to try to do less. But it's talking about how do you recalibrate, what's the the robustness around the veracity of the your dispensation, how do you calibrate the false positive, etc., and manage that. So we are seeing a lot of that activity. A lot of banks are trying to basically start having these alert factories, they call them, in terms of using managed services. So that's from my perspective. Maybe Pascal, you want to sort of share what we are seeing in how banks are trying to reduce these models with automation?
Yeah. Thank you, Gary. I think what you just said is spot on. Perfectly right. There's a lot of time spent on false positive, for instance, on AML, and trying to group things and trying to get away with some simplification there. What I see also happening a lot in financial institutions often is trying to automate, but actually mostly in a way that is impacting the internal part of the bank. So what I mean by that is trying to put very often, when I see a lot of the KYC platform being deployed in large financial institutions, be it things that they build internally or that they buy on the market, very often it is mostly or often focused on a workflow system. To streamline the work between the middle and the back office of the bank, and therefore trying to make the process a bit faster, which has an impact on turnaround time and therefore improve a bit of the cost and the turnaround time. That's great, but it's usually, unfortunately, quite limited, and also doesn't really impact the customer experience, other than the fact that it's a bit faster, but not that much. And that's a bit of a shame because it doesn't really move the needle that much. But that's at least a start. That's the starting point.
Yeah. Thanks for that. Maybe in the mindful of time, that's about what FIs can do, but what are we still seeing that are still getting it wrong? What are FIs, what is things that they are still there and that's still really not fixed? Maybe we will just start with you, Pascal, maybe for you.
Yeah. I think the first thing is, this panel is name is Corporate Onboarding and Data Portability. So it's a lot about corporate onboarding, right? But actually, we need to zoom back. It's a lot about a broader customer lifecycle management when it comes to corporates and their interaction with financial institutions. So it's not like client onboarding can be viewed as a standalone process. In our views, we have firm beliefs that it needs to be a holistic approach with an entire ecosystem to support the financial institutions in their interaction with the corporate customers, to have a better and proper risk understanding, to Satyam's point earlier, when it comes to different type of data points and data sources and type of indicators that you can feed into the risk understanding of a corporate customers. It's about all the ongoing interaction with customers. It's about the refreshes, but also the perpetual knowledge and understanding of your customer. It's about data portability. It's about all of that. And that's why in Chekk, we built a platform around 9 capabilities which support the entire chain here and the entire journey, from easy to create and maintain digital forms with even no code environment, to the connectivity to the company registries and commercial data providers we were mentioning earlier in the panel, to the broader risk assessment solutions, including various type of data points, even non-traditional ones, to advanced IDNV, identity verification, to secure data wallet and the portability, etc., which plays back to how to connect in the future, now after, into the utilities we mentioned earlier. So we're trying to have this holistic approach because we're firm believers that it's not only about corporate onboarding, but actually a much broader picture. And it's not only about the future, it's something that can happen now. So I'm hoping that out of this panel, the people who are looking at video are not kind of thinking, oh, it's corporate onboarding is still too tricky for financial institutions to tackle. We need to wait for the future when KYC utilities will happen and all, because in reality, there are already solutions, be it what Chekk provides or some others, that can really make a big difference from a process, a system, and next customer experience perspective today for the financial institutions with their business customers, be it the large multinational corporations, large corporate, or even the SMEs that Satyam talks often about and that are dear to his and my heart.
Satyam, maybe any of your views in this area, what are banks still getting wrong? And, we talked about it a bit, but maybe you just want to share.
Yeah, so I would say 3 broad points. So one, and this is something someone very senior kind of told me in the bank, that as long as KYC is always looked at as a separate activity and a pure risk management activity, it's never going to work. And if you look at the questions that's asked, it's a beautiful opportunity also to understand the customer better, understand what are the opportunities, in terms of offering the right products or solutions for the customers. If you understand the nature of business well, and if you understand, how the company is structured and so on. Unfortunately, I think that's not happening, and that's one thing which needs to happen. That when you do know your customer, it's not just for the purpose of compliance or regulation. It's also the opportunity for whoever is interacting with the customer to understand the customer better and offer them the right solutions, right? So that's one thing I would say where there's a great, area for improvement. Number 2, I think as the whole problem got solved, or banks have been solving this, there's been a lot of focus on ensuring you let the right customers in, which means doing a lot more due diligence upfront, or making that process a lot more rigorous, irrespective of the product that the customers want upfront, and so on. So almost, if I have to say, all customers today are possibly evaluated assuming they've kind of taken, they take the highest risk product that the bank offers. And that may not be just the right approach, And then if you look at fintechs and new age, companies have kind of beautifully solved that challenge. And it may not be because of the level playing field on regulations. There might be some element of it, but it's also because they are only allowed to do certain products, and they do those products beautifully, and they kind of understand the customer in the context of whatever products they're allowed to do. So I would imagine an approach where it becomes, your customer standards or your CDD standards are more aligned to not just the risk profile of the customers you're onboarding, but also what kind of services are they wanting, right? And as they kind of need more services, you kind of do more, I would say, due diligence. And the third area I would say is the entire alternate data, where there's a lot of work happening again in the credit risk space to understand the customer better, to underwrite using all alternate data that's available. But I believe there's an equal amount of opportunity, besides the corporate registry and all that, in this space as well. And just to give you an example, Global Linker as a platform, we are all about creating a digital community of SMEs. And we see our roles as digitizing, aggregating, and advocating for SMEs. And we and what I mean by that is today, as an example, we work with a number of trade organizations, including, let's say in India, we work with Federation of Indian Export Organization, which is something under the Ministry of Commerce in India. Now, if they are bringing in their exporters onto the platform and they are vouching for them, and let's say we also kind of have their import-export certificate number and all that. Now, that's a very powerful information that's kind of sitting out there, which can be used by any financial institution who tomorrow, wants to bank, wants to, serve these exporters. In the same way, if somebody is kind of creating their digital product catalogs, on a platform like ours, or if they're attending certain, webinars, which is on how do you sell export to a certain country and all that. Now, these are very important pieces of information which could, in a way, be used to understand the customers better. And I don't think there's much work that's kind of happening there today, but it's certainly an area which would definitely benefit the financial institutions, and more importantly, the SMEs or the businesses, would benefit a lot in terms of what's being asked out of them versus what can be in a way inferred from that's everything that's available.
Yeah. So I mean, I totally agree with you. I mean, in terms of how the first line and the second line actually should be working together, right? And one is the other side of the coin, where it's good to understand your customer, but from that perspective of what's the personalization, understanding his needs, but at the same time, you still have some form of supervision and control in terms of making sure that the risk is minimized from an AML perspective. And obviously, another thing to watch out in this space is obviously ESG as well, sustainability and all that thing that's coming up in the future as well. So I think there's a lot of opportunities from that perspective as well. Maybe just to round off, I'll just go around the panel and ask maybe for some last comments, just to wrap it up nicely. Satyam, you maybe, since you're the last, would you like to just give
So I believe, I know in my opening I did talk about a lot of regulatory thing, but I believe it's something that is required even beyond regulation for the betterment of the the whole requirements around knowing the customer, protecting the community. So I believe that's something that is required absolutely, and the sooner we find intelligent and innovative ways of kind of solving that challenge in the interest of customers and keeping the bad actors using the financial system, that the better it is, for the economy and for the community,
Yeah. Maybe from my perspective, I think with the problem statement I talked about, the banks are really talking about how, from a customer experience perspective, as well, omni-channel, looking at that, like I hope, they don't end up trying to remediate just because they've got a stick at them by the regulators and trying to just tick the box. They're starting to think about innovative ways and incorporating certain things. A lot of this, discipline around statistics. So they talk about trigger-based reviews. They talk about perpetual KYC rather than this cyclical, seasonal things. So I think there's a lot of technology out there. Hopefully, someone can bring everything together that will provide a solution that can sort of solve the problems of today and also look for the problems of tomorrow in a sense, because we always get into this trap, right? So of solving problems today, spending a lot of investments today, but always having to look backwards, and to say, okay, this is something that we spend, but it may not be fit for purpose for the future. Maybe Pascal, you'd like to provide your last comments and close us.
Thank you very much, Gary. I think maybe a couple of things. Yes. First of all, it's very important, as you said, Satyam, to remember why we're doing all that. Okay, all those KYC and KYB rules are here to prevent money laundering, terrorist financing, sanction evasion, fraud, tax evasion, all the bad stuff we all want to stop. Okay, so we need to sometimes stop a minute and remember why we are doing all that, because it's dear to us as community members to make sure that it's a safe community environment and better world. At the same time, as we said before, it's also about how we do it in a way that is not only for the tick boxing exercise, but actually better understanding the customers and deepening of the relationship, and make really a better kind of interaction with customers as opposed to a burden. I think that's the first point I'd highlight. The second point is, as we said before, I think when we look into the future, there's going to be a lot more data points and type of non-traditional data that can fit into the various KYC, KYB, and broader activities like this. And the key part which will catalyze all that, one of the key channel, will be indeed some of those KYC utilities that we refer to. And even though they are sometimes in some countries a bit difficult to kickstart, or they take a few times to try again, it's okay. Everybody stay motivated and we'll make it work. But I think that's what will make a big difference in the future. But especially if there is, to your point, Gary, more cohesive and joint work between the various players in there, the financial institutions, the regulators, the government. And if it's over time, not only something per jurisdiction, but something that is actually more kind of cross-jurisdictional, kind of cross-countries, kind of the utilities that are suddenly emerging. Because when you talk about corporate, a lot of them have relationship in more than one country, and so that's going to be a big important part. And the last thing I would highlight is the fact that, as I kind of alluded to before, in the waiting of all of that happening, kind of more type of data and kind of utilities and all of that, it's important that financial institutions remember that they can today do things that really make a big difference, because there are already capabilities out there that makes a big difference to the experience and to this turnaround time and to all of that, whether it is with what Chekk provides and enable the banks and the financial institutions at large to do with leading edge capabilities, or whether it is with some other providers. There are already things today that can make a big difference. So it's not about waiting for in 10 years when something might be happening. It's already today something that FIs can act on to make a really different experience and process for corporates. So I would just close it by saying thank you very much to all of you for having joined this panel. Really great chat and experience, and thank you. We had some technology issues in the first place, so Una couldn't join us. But really, thank you very much for your participation and the great questions and answers.
Thank you, everyone. Thank you.
Thank you. Thanks.
Thank
bye.
you. Bye.
Thank you. Have a great day.